Subir Gokarn, Director for Research at Brookings India, and the former Deputy Governor of Reserve Bank of India joins in on the show from New Delhi. Mr. Gokarn, thanks very much for being with us. Sir, we've seen the U.S. Treasury yields off late. They have risen on stronger than expected private payroll data. So what's the view that's coming in on the U.S. economic data, especially given the fears surrounding QE tapering, the debt ceiling, etc.?
Well, I think what we have to look at from the U.S. perspective is two things. One is that from the macro viewpoint, growth patterns, the growth trajectory seems to be fairly stable and quite positive. That is, there is a recovery on track. It is, if not gaining momentum, at least holding steady. So from the global market viewpoint, the U.S. as a consumer of exports from many other countries, this is very positive, and it is fairly, I would say, reassuring at this point. The two negative aspects of the U.S. macro environment you've just pointed out. One is the risks associated with the lack of reconciliation both on the budget and on the debt ceiling. Now, we saw that risk becoming very significant in October, and then being pushed to sometime next year. Whether we'll get a more permanent reconciliation, a more permanent solution to that or not is still questionable. The risk remains, therefore. We don't know, and we can't predict what will happen if no solution is found, if a confrontation is precipitated. I think the taper is partly related to the growth momentum. So given that the economy is stabilizing, given that the recovery is showing increasing signs of persistence, the taper is inevitable. Somewhere along the line, the Fed has to start rolling back its liquidity measures.
We've also seen a bump up in the rupee of late. Yesterday, of course, was quite a strong day. In what range do you see the rupee, especially given the fact that we've had favorable current account deficit numbers? The risks of political uncertainty, of course, continue to be there. And we've also seen maturing of the OMC dollar swaps as well as, of course, the QE impact.
I think till the tapering actually starts and we, get to know what the space of it is and what the magnitude of it is, that in itself, I think, is not going to be much of a destabilizing factor. So I would say that given the current account scenario, given the U.S. scenario, that is the sort of potential time frame and magnitude of taper, rupee should be fairly stable in the range that we are seeing now. There are, of course, other shocks that are possible. Many that perhaps we can't even visualize right now, a sharp spike in energy prices or something like that. Or, as you said, domestic political outcomes which are inherently unstable. Now, if that happens, that is a shock that will obviously add to some instability. But bottom line is that if the current account deficit is within manageable limits, and clearly 1.2% of GDP is certainly within manageable limits, the degree of instability will be much less. It will be contained. I think that's the reassuring part of this data.
Mr. Gokarn, do you see the CAD number is much below the $50 billion mark for FY14? And are you seeing any structural improvement in CAD that will make India comfortable on the CAD front, even for FY15?
Well, I really don't have the ability to make a number call. I haven't been looking at the numbers that closely. But I think there are two issues that we have to emphasize on the structural side. One is clearly the rupee depreciation is helping exports grow and imports be contained. Anything that is imported that has a domestic competitor, now the advantage swings to the domestic producer. So that is a very positive response to the rupee depreciation. And the general argument that a depreciated rupee does in itself help to correct the current account, I think that factor is at work clearly now. But the other side of the equation is all of the issues that have added enormous pressure to the current account over the last 2 years, certainly, perhaps 3 or 4 years before that. Gold, iron ore and coal, all of these, the minerals, have put enormous pressure on the current account. and we don't yet have any clear solutions to those. Gold, of course, the imports have gone down sharply, but we have to be sure that this is happening because people are buying less gold and not because gold imports have been diverted into unofficial channels. So overall, I think the structural pressures on the current account, particularly coming from the mineral side, the mineral complex, I think remain, and we need to address those through structural measures. I think that is something we cannot lose sight of.
How comfortable are we on the forex reserves now with the reserves at around 8 months? I believe we have an 8-month cover, and also RBI has received nearly 34 billion via both the forex swap windows. Can we now say that we are fairly prepared to face the QE tapering as and when it happens?
I think this idea of forex reserves and comfort levels is being cast in very simplistic terms. I don't think we should look at it in terms of whether a reserve is adequate or enough in any absolute sense. It's a question of what your overall foreign exchange policy regime is. To the extent that we have a floating exchange rate regime, we have demonstrated that repeatedly over the last 3 years, that when there is pressure on the currency to depreciate, it depreciates. When there is pressure on the currency to appreciate, it appreciates. Having accepted that as the foreign exchange or the exchange rate policy regime, then reserve adequacy is not that critical a factor. Yes, you need reserves to meet emergency situations. Yes, you need some reserves to intervene in times of extreme currency volatility. And I think clearly from those two objectives or those two perspectives, we have adequate reserves, and we've never had inadequate reserves. If you want to move currency regimes to something else, like peg it or to prevent depreciation at any cost, then that is a different regime, and you need a different kind of criteria and a different set of resources to manage that. But we're not talking about that now. We're not talking about change in the exchange rate policy regime. We're talking about whether we can stabilize the currency in a generally floating environment, and I think clearly we have the capacity to do that.
And Mr. Gokarn, lastly, a word on the RBI stances as well. Do you think that the RBI interest rate cycle has peaked, and if you were at the governor's shoes, would you also shift focus to growth rather than just inflation?
Well, I'm not in that position, so I can only comment as an outsider now. The basic concern is, I think, that if you swing to the emphasis, the pendulum to growth, as was being done in the first half of this year. We saw 3 successive repo rate cuts, but after that we've seen 2 hikes, and the main reason for that is that as a result of rupee depreciation, inflationary pressures have re-emerged. I think you have to be logically consistent in your monetary policy approach. You can't be flip-flopping in terms of objectives or instruments. So given the inflationary pressure that we're seeing, given the fact that the headline numbers have not eased, and given the fact that at least the new regime is suggesting they don't have a formal framework, the framework will be announced in a month or so, I expect. But the emphasis is now shifting to the CPI as the inflation benchmark. That as long as the CPI is high and stubbornly high, you really don't have a choice from the viewpoint of consistency to be raising interest rates to deal with it. So I don't see any signs on the inflation front that would allow for a reduction in interest rates at a time when the inflation numbers are so high.